Welcome to Saltivation. The Saltivation Show is a podcast series featuring the leading voices in salt, where we talk about the issues and strategies to help you make sense of state and local tax. We're back this week with the second installment of our engaging discussion with Professor Richard Pomp and Jordan Goodman, where we've been discussing the duo's top 10 lists and their thoughts on prominent tax cases and other state and local tax topics.
Are there any other recent tax decisions that you think are just really bad policy?
I'm trying to think. The last cases we went over, which I happen to have a little subset here. What was the most outrageous state decision that we talked about, Jordan?
Do we talk? I don't know that we talked.
This was really stupid. Well, you yell, I talk. So this was really stupid.
I was going to talk about the thing that, from a policy perspective, that's really making me crazy. Yeah, is this debate about whether the proceeds from the sale of a capital event should be included in the factor. It's included in business income, right? It's included in business income, but we don't want to include the receipts. And I think that is just stupid. I just think it's wrong. And this is actually a debate that's going on now around the country about when to include it or not. And I think California probably has the best approach to it, although I'm in California and I'm hitting them on the head with their own laws, and they don't even know which way is up. Really, they say every gross receipt should be included. If it moves the factor 5%, you got to show that it's not distortive. I go, okay, that's a legitimate thing. The Utah one we talked about, you have to show where a lot of it's goodwill, right? Gain on capital events, goodwill. You got to show where it was sourced to, or show me some event to it before you include it. Well, I don't think that's the right test. California, for me, it's like, how is it not distortive? How much income did it generate compared to your normal income?
Right.
Right. That's the question. That should be the subjective, numerical test. And I've got a client that's got 95% of its income in the year is generated by the capital event. And they go, we're throwing out the factors, but it's business income. I'm baffled. I go, how could it not be included in the factor?
Yeah. This is kind of the old Microsoft case and General Mills, treasury function and hedging. And they're hard cases because the gross receipts can be so enormous, being generated by a very small profit margin. Now, on the gain of the sale, you have this enormous capital gain that accrued over time. And you're apportioning it it's almost serendipitous what the apportionment formula looks like in the year of the sale, when it took 25 years to that gain to be generated.
I disagree.
And the question is,
it doesn't take 25 years for the gain to be generated.
The capital gain.
The gain occurs at a particular point when you sell.
Yeah, but that's not when the gain was.
Isn't it talking about like the accumulation of value just didn't happen overnight?
And then you take current apportionment factors, and you're like, that's how we split it.
And I would say theoretically the right answer is you should average the apportionment formulas over time. Let's say it's goodwill. No, goodwill doesn't happen instantaneously in the year of the sale. It has been generated over time. And where do you source it? If you are going to put it in the apportionment formula, whose numerator should get the capital gain? That's the rub.
I could live with that if that was what the statutes say, but the statutes don't say that. They either say all sales from big transactions get removed per se, without an explanation that it generated most of the liability, or I'll give you a piece of it, or I apportion it someplace else. It doesn't say that. And that's why I think from a policy perspective, the way the states are approaching it is just dead wrong. They're just saying no. That's wrong.
Oh, yeah. They don't know what to do. They don't know really. That's why I said theoretically. Yeah. They don't know what to do as a practical matter. Now, we actually, Jordan may not remember, we were on the same side of Meade. It was handled by Jordan's firm. And when it was remanded, we got ready for a second round before Jordan was able to settle this case on remand. And we had to confront, what if the gain were going to be taxable, and if Lexus was going to be taxable by the states in which Lexus did business? Forget me, just Lexus, carve it out as a freestanding entity. what states should have a piece of that capital gain, which is a couple $2 billion capital gain. And we had some theoretical discussion in a white paper I did. And then, of course, the case was settled and that was the end of it. But the VAS case out of Massachusetts may raise exactly this issue, Jordan.
Yeah.
You know, what do you do that sale of a partnership interest, enormous capital gain, and then who gets a piece of that?
And that's the area we're seeing it right now are these sales of pass-through entities. Mm-hmm. Where does it go? And the states are scattered. You've got California saying if it's business income, you look to the factors of the entity being sold, not the asset being sold, which is, to me, theoretically inconsistent, but I understand what they're getting at, kind of what you said. Then you know where you've been, therefore, historically, where the appreciation occurred. I think it's misplaced, but I understand that at least. But the states are all across the board as to whether it should be where it should be at the asset that's being sold or going through to the entity that's being sold and what historical, and that's what Vectrum's all about. Right, that Vectrum case is all about the anomaly of going into Michigan, where you normally have a 3% factor, having a 70% factor in a year of sale, and how distortive it is. And the court got it. The court's gotten it twice now, right? So that to me is kind of the upper limit.
Well, that illustrates my point about how gain can accrue over time, and it's serendipitous. Where you are, the year it is finally recognized. And you may have an apportionment formula having nothing to do realistically with the gain. Well, we have equitable apportionment. It's a safety valve if you can get a court to understand what you're saying. The stupidest case, I think, is the one out of Indiana. Did we talk about that together, Jordan? The Express Scripts case.
Yeah.
Basically, a management company doing what Anthem used to do before they outsourced it to Express Scripts, just managed the drug reimbursement program. And they didn't sell drugs. CVS sold drugs. Walgreens. And Indiana, the tax department says, you're selling tangible personal property. And they go, say what? We're a service provider, and we're in a state that at that time was cost of performance. And Indiana, you don't get any of the gross receipt. And the department said, oh, no. You have an entry. This has fascinated me, by the way. There's an entry on their federal tax return where they have put their normal deductions, but they call it cost of goods sold. Have you ever run into this, Jordan?
Yes.
You have. What is going on?
Where I've seen it where they use cost of goods sold because it doesn't matter for federal purposes. It's just a deduction, but the state will jump on it. And the opposite in Texas, unless you call it cost of goods sold, you don't get it as cost of goods sold, even if it is cost of goods sold.
Yeah. Well, that cockamamie.
Because it doesn't fit in all the other categories. Right. So you're like, well, I'm going to throw it here. And it is validly deductible.
A deduction's a deduction.
But your law firm doesn't have a cost of goods sold. You deduct your associate salaries and everything else on a line on the return. You don't need to create cost of goods sold. So I never understood it, but the department jumped on it. Jordan's absolutely right. Jumped on it and said, well, look, obviously it's selling product. And that brings them outside of cost of performance. Into the destination rule. Luckily, Indiana is one of the great tax court judges in the country, Judge Wentworth.
Right? Yes, Judge Wentworth. Yes.
She's wonderful. Calls it as she sees it. The department hates her. They, in fact, I noticed that we seem to be settling more cases because they don't want to go before her. So it's getting easier to settle in Indiana. But she's wonderful. And she saw right through them in this case. When you read the opinion, it kind of drips with scorn. Not a very good department. That's one of the worst cases I think I have read recently. But cases, I don't understand why they're brought. The two that come to mind, Chevron and was it Citgo? They brought a case that was essentially relitigating General Mills. General Mills was about hedging, and it was their inventory control program in buying, to protect the price of corn and whatever they put in their cereals. And it went to trial, and the court said, yes, it's a gross receipt, but it so distorts it that you will give you the gross receipt, but you can't put that gross receipt in the denominator. It's a gross receipt, but under equitable apportionment, only the net gain on your hedging will be put in the denominator, which is the approach many states take with the treasury function. You buy commercial paper on day one for $1 million. On day two, you get $1.1 million back. And you'd like to say your gross receipt is $1.1 million. And you do this day after day after day. And pretty soon you got an enormous gross receipt. And then the states don't allow this anymore. Anyway, Chevron hedging against the price of its inputs, and Citgo, I think was it Citgo? They litigated this. And of course, they got their butts handed to them. It was a ridiculous case to go up on. And I thought we had seen the last of those cases, but I guess not.
Yeah, particularly California, they've kind of got it regulatorily nailed down of what they have to do, what the test is. I'm not sure.
And in California, because of General Mills was one of them, and Microsoft was another in California. So American Honda, one that Jordan and I talked about.
That's, again, not my client, not my case, not my understanding. Don't know. Don't get it.
Why don't you explain the facts first?
Okay, well, they make a little bit of money selling vehicles. They make a lot of money on earning tax credits. And they sell the tax credits. It was hundreds of millions of dollars of tax credits, like $250 million of tax credits year after year.
Yeah.
And it was more profitable than their operations, and they claimed it was non-business income. Okay, sourced to their commercial domicile. And
California happened to be their commercial domicile. What do you think the odds were they actually had that number on their California return? But the case doesn't say.
But that went up to the Arkansas Supreme Court. It was a case of first impression. They really have not looked at, you did the definition of business income in Arkansas before. And I don't disagree with the decision. I'm an optimist. I looked at the decision of the Arkansas Supreme Court, and they really said something that's really important for all of anybody who's listening in the salt world. They gave no deference to the regulations issued by the Department of Revenue in Arkansas on what business and non-business income is. They said, we can read the statute. We don't need your help. Thank you very much. Which to me was the most important thing of American Honda, because the issue itself as to whether these tax credits they sold year after year were business income was kind of a silly question.
They had a division in the company in charge of selling these credits. You couldn't ask for a more straightforward business income case. Never understood why they thought they had a shot at this. But this issue of deference is a big issue, as you folks know. I don't know why you would want to put blinders on and not even look at what the department did. They may have some insight that you don't have as a lay judge. I would give it whatever deference it deserves and look at it. You don't like it, you think they're wrong, fine. But how can you be ignorant? Why do you want to be ignorant and remain in the dark about what your tax agency, the most knowledgeable people in the state, presumably, think about this problem? De novo is fine. De novo with whatever respect you think it deserves, maybe even better. So,
well, I think that's, judges, the good judges always say, I'll take that under advisement, right? And then they either listen to it or they don't listen to it, they do it themselves, but they kind of do it in the privacy of their own office by saying, we'll take it under advisement.
Yeah, right.
But I love it, and that's one that should be quoted all over the place, is because department's opinion, worth nothing. I like it. Judges can read statutes too.
Yeah, you like it until the regulation helps your client.
Well, but then of course
then you like it. Yeah, then it ought to be listened to. So, 2 weeks from now, Sirius Radio is being in Texas, and that's
2 weeks. Okay,
2 weeks, week after Thanksgiving.
Okay.
Our buddy Jeff Friedman is arguing that in Texas, and that's a big one.
Yes.
Now, it's just interesting. The lawyer arguing for the state when he was in private practice actually argued the position that Sirius Radio is taking. And then they're saying, look, based on your case law as much as the statute, it's where the content was produced.
Right.
We don't produce much content in Texas, it turns out.
Right.
There's something called Willie's Road Show, not Willie Nelson, and a couple of hours a week, but that's it. It's all hours in New York, and the state is saying no, we're a market-based state, even though they're not. And where's the market? Well, your business is really decrypting signals at the in the car. That's what you do for a living. You decrypt signals, and that takes place. I see now. Here's a question that takes place where you have interstate truckers. They're big Sirius Radio subscribers, but you don't know where they are, so you got to use billing address.
Mm-hmm.
Gordon, you run into this in Chicago all the time, don't you? With the aggressiveness. So,
transaction tax, right? Billing address, but at least the city of Chicago allows you to prove by affidavit that it's being used outside the city, right? So they have an apportionment method. So I got to give them kudos when I have to. But this whole issue about being a cost of performance state, well, it's which cost of performance are they looking at? Mm-hmm. And they become so specific as to putting the credit card in the slot to where the antenna is located. Mm-hmm. Those aren't really cost of performance. Those are pieces of the possible way that you get the service and pay for it. It's not direct costs that I grew up learning in cost accounting. Those aren't the direct costs. Where the antenna is located. That's a function of how to deliver it. That's not maybe a piece of it, but certainly not all of it. No. Even on a transaction by transaction basis.
Well, I'm pretty sure radio, which is free, but do we source advertising to that, the revenue for that based on where it's listened to? And that is a moneymaker, radio. So I don't know, that it just seems very contrary to me.
The states like to use population.
Yeah, right. Nielsen ratings, those kind of things, a little bit more specific than population for any kind of advertising and broadcasting.
Yeah. The thing is, Nielsen ratings, they're such a dinosaur because of the mobility we have to watch things on the move.
Right. No, the IP address of your phone is the same no matter where it is, right?
Right.
And who hasn't watched the show not at home?
Right.
On the phone, right? So it's really an inexact science. And what it comes down to, you just start making stuff up. And you can use a different word for the S, but I'll use stuff. It's a family program, but it's just making stuff up and whether it's fair or not. And as the Supreme Court said, it's not exact science. It's an art. And we'll give you some
leeway. As people who have drafted for a living say, the perfect's the enemy of the good. We can't get this statute perfect. Let's just get it good so we can go home. It's 3 a.m, take a shower. We got to be back at 8 for the leadership meeting. So, and this will be the challenge I see in many of these situations, Jordan. How close do you have to get to the right answer?
Right. And then the information you can get from companies about how they make their money, that's a very complicated story to unravel from an accounting and record standpoint. I mean, we have a client that redeems coupons, and Washington took the position that the redeemers were the moneymaker when the coupons weren't paid for by the redeemers at all. They got a little discount to buy the good. The manufacturers paid for the coupons. So that money came out of state. So how does Washington get to glom onto that? But the money wasn't big enough to fight. So there is this thing where people are going to get taken advantage of if it's not material, where the states are going to make a grab for the money, and there's going to be multiple states getting the same money. And I think that's really problematic.
You have hit on a big case in New York that just came down, B&H Photo. If you've ever been to New York, where are they, 47th Street or something? They're one of these big well-known mail-order companies and cheap prices and whatnot. And you go to their website, which I encourage you to do, and you'll see price of this camera, $1,000 with a big X through it. Today's price only $900. And that's what they collected sales tax on. It was a whistleblower case, which Jordan has great experience with in Illinois, home of one of the big whistleblower law firms. And the whistleblower said they should be collecting on $1,000, and state, you're losing tons of money. And the AG actually says, okay, we're going to take this case. Talk about a stupid case, right?
Yeah.
$1,000 price, which no one ever pays because it's always on sale. The wrinkle is exactly what you said, Judy. The manufacturer gives a subsidy to B&H B&H Photo on a certain amount of volume that they sell. These cameras, they're not required to lower the price of the camera. They're not required to put it on sale. But you move a lot of our stuff and you're going to get a discount, like a volume discount. And because of that, the whistleblower thought somehow there was the manufacturer's coupon in there. I testified in this case and basically said the sales tax is supposed to be imposed on consumption. What's the consumption here? What do you pay for it? That's your consumption.
Right.
Might have sold for yesterday, what it might have sell for tomorrow,
right?
What one might pay for if they didn't have a coupon. What did you pay for it? That's your consumption. And we just won this case, and big win. Embarrassment to the Attorney General because Jordan knows better than most, being from the home of whistleblowers and Ketons and all that. The Attorney General has to decide whether he is going to get involved. She, in case of New York, whether she's going to get involved or not.
She did on this one.
Jordan, why would you get involved in this cockamamie case? A no-brainer from the start, I thought. When I first got called, you're kidding. You're not kidding? They actually think sales tax should be on $1,000, a price no one probably ever pays.
I can't believe that they really understood the facts, honestly, because it's a Jerry Maguire moment. Show me the money. What did I get paid? That's really what the consideration is, and they kind of blew that. And they were thinking of a manufacturer's coupon where they get reimbursed, or so. I don't seem to me like they didn't really understand the facts when they got involved in it, because clearly on the facts that were true, there was no reason to litigate the case.
Yes, then that could be that someone had stars in their eyes. And, but silly, right?
Yeah, it was silly, but but you got paid. It was all good.
Yeah, I got paid.
So
not a contingency. An expert witness cannot work on a contingency. And then I got cited, which was nice. So I was happy. Client was happy. Everyone's delighted. I don't think it's going to be appealed. So,
I hope not. That'd be way too good.
Manufacturers have a lot of ways to get money to the vendor, not just with a coupon. And I don't think it matters which way they do it. I would say even with the manufacturer's coupon, what did you pay? Not what the vendor get reimbursed for.
Right.
What did you pay? So it's not like they're paying you. That would be income. Paid you anything. So I don't care what piece of paper you give the store. What did you pay for it out of your cash? That's the only thing that matters.
Well, gentlemen, we really appreciate this conversation. And for us today, that's what matters. And so, maybe we'll just have to have you back and, maybe in a couple of weeks, we'll talk about Sirius, but we really do appreciate your time. Jordan, Professor Pomp, thank you so much for joining us. This has been another episode of Saltivation. Until next time.
This podcast is for educational purposes only and is not intended, nor should it be relied upon as legal, tax, accounting, or investment advice. You should consult with a competent professional to discuss specifics of your situation and the applicability of the information presented.